Good morning, everyone, and welcome to MacroAce with your host, Tony. I'm also the head financial analyst at FinancialJuice. Hope you're doing well, and hopefully you're able to get enough rest from the FOMC rate decision last night. Let's go through the Bank of England sentiment, what it means, what have the central bankers from the Bank of England said in the past, and what are the other sentiments from investment banks as well. So what is it? It's the rate that the banks pay interest to commercial banks. And then why is it important? So when you have higher rates of interest, that's they usually will slow down growth or make sure it doesn't get out of hand. And then there'll be other areas that the central bank might want to control as well, such as the inflation aspect of the economy as well. And then on the flip side, you have lower rates where if the central bank decides to start cutting rates or is cutting rates, then that's to support growth or to create growth within the economy if it's seen as faltering or not strong enough. And then, of course, it affects how banks handle loans and mortgages and credit to not only businesses but also consumers as well. Then where is the economy at the moment? So, of course, the key part of this is going to be what inflation was like and how that's changed sentiment for traders and investment banks alike. And we'll go through that in a later slide. But first of all, unemployment rate was at 4.3% compared to 4.2%. Unemployment change at 0.9k compared to 29k. The employment change was at minus 207k compared to minus 66k. Average weekly earnings year on year were ticked high to 8.5% compared to 8.2%. Inflation was ticked down to 6.7% compared to 6.8%. The core data also ticked down quite by a much bigger amount, 6.2% compared to 6.9%. GDP data for Q2 was at 0.2% versus Q1 of 0.1%. And the year-on-year data at 0.4% compared to 0.2%. Services PMI was at 49.5 compared to 51.5, and the manufacturing PMI is at 43 compared to 45.3. So a reminder for the PMI data, we're going to be getting the PMI data for tomorrow alongside with the services and the composite data. So of course, Bank of England keeps an eye on how the manufacturing sector is doing and how the services sector is doing as well, but the key aspect is inflation and trying to bring that down. So let's carry on then. So you had retail sales that was at minus 3.2% compared to minus 1%, and month on month at minus 1.2% compared to 0.7%. Then the previous Bank of England statement that we had with the rate on August 3rd. So they raised the rates to the highest level since 2008. Forecast shows inflation in 1 year's time at 2.82% compared to May's forecast of 3.38% based on market interest rates and a modal forecast. And Bailey also said that rates policy is restrictive now and is having an impact. So carrying on with Bailey's comments and other comments as well. So you had Bank of England's Dingerer, who is the most dovish member of the central bank, who voted for no change last time round, said the policy is already sufficiently restrictive. Bank of England's Pill on August 31st said that one option for policy is to hold rates steady for longer, and he tends to favour that approach on rates. And off the back of that, the reaction on the pound was that it had weakened because the sentiment then has shifted that the central bank might be more inclined to hold rates rather than raise rates. So there was that short-term reaction that we had there from the pound off the back of Bank of England Pill's comments. And then Bailey said that we're no longer in the phase where it was clear that rates needed to rise, and we're now data-driven as policy is restrictive. So again, it's similar to what the Federal Reserve has done, is with regards to the wording of the comments, is saying that policy is restrictive enough or it's sufficiently there. That's the kind of comments that you're getting those similar comments from the Bank of England too. So if they do decide to hold rates today, it's not completely out of the blue, considering the CPI data that we had yesterday that more or less that added more to the bets that central bank might hold rates rather than raise them. Although still the majority of economists are looking at the central bank doing one more hike at this meeting and then keeping the policy at where it would be at 5.5% if they were to hike today. Investment bank views then and market views. So you had MUFG that said that they discussed the high possibility that this week's UK labour report and CPI data could influence market expectations surrounding the Bank of England's rate hike, and recent statements from Governor Bailey and Chief Economist Pill hint at a more dovish stance, which may affect the pound's performance in the short term. So, of course, we've already had the CPI data, as I said earlier on. It was weaker than expected and compared to the prior figures. So there is there are more bets, or there is a higher expectation than there was before for no change. Goldman Sachs, they said initially they expected the Bank of England to hike rates by 25 basis points, while predicting a stable Euro GBP pair due to various factors, and policymakers have signalled a preference for holding rates higher for a longer period as opposed to implementing additional hikes. Then ING, they also added that they expect one final rate hike from the Bank of England this week, with wage growth and inflation both proving stubborn, but recent comments show that the bank is laying the ground for a pause and that they're not ruling out that on Thursday. They also added that any hints on Thursday that UK policy rate was something like sufficiently restrictive would most likely hit the pound. And they also added that the Bank of England pauses in September, or if the Bank of England pauses in September, but hints strongly that it could hike again in November, it could be tempting for policymakers this week. So that scenario could be what could happen if they decide to pause at this meeting instead of doing a rate hike. So again, similar to the Fed, being data dependent, if they see inflation making its way towards their target, although inflation is still 3 times what the central bank's target is in the Bank of England of 2%. If inflation is seeing some significant declines, particularly in the core data, right, then that would help the bank's scenario or expectation that they wouldn't have to do another hike this year. Let's say, doesn't matter if it's in September or November. They might decide to do the hike today and just say the rates are sufficiently restrictive and they don't need to do, but they still need to keep rates where they are and keep monetary policy tight, and then see what the effects are on the economy, and then take those into consideration and be data dependent on their future rate decisions. So market pricing, so August 17th, you had UK OOS curve pointing to roughly 80% chance that the Bank of England rate will rise to 6% or more by February 2024, according to calculations. 18th of September, investors are pricing a 20% chance of a no change decision. And then September 14th, you had Bank of England rate peak to peak at 5.5%, according to a narrow majority of economists, which was the same as the August poll. And then from September, from what we had yesterday, traders priced in a 70% chance of a Bank of England hike Thursday versus 90% chance earlier. And the chances the Bank of England pauses rates on Thursday rose to 31% from 20% on Tuesday after CPI inflation falls. So that was according to the OIS curve. So you had comments from the likes of Goldman Sachs switching up their tune, saying that they expect the central bank to hold rates rather than raise rates following the rate decision that had come about from the CPI data that that we had yesterday. So there is that shift there, and there is the expectation that has built up more that the central bank could pause. Now, what that means for the markets is that if the central bank does pause, it means that the market reaction, if the central bank doesn't meet the expectation for a 25 basis point hike, the market reaction might be moderated, i.e., as expectation grows that the central bank will pause rates, then you would have traders who would have speculated on that and priced it in. So the stronger that becomes, the weaker then the reaction becomes when the actual rate comes out. The only thing that would make it more difficult is to see how the rate statement supplements, or if it goes against what the central bank has said, or if there are any surprises, then that could create extra volatility that the markets might not have expected if any comments had come out that had surprised the markets. All right, so this is the last rate decision that we had here. So this is about 10 seconds before the last release, so back on August 3rd. I'm just going to play the video here. I'll just bring on my deviations too. Okay, so the rate was raised by 25 basis points as expected. You had one person who voted for no change. Everyone else was in favor for a rate hike. That'd be good. Apologies on the quality of that. It just changed up. Yeah, as said, everyone else voted for a rate hike. Only one person voted for no change. And if I kind of push forward a bit more, you can see in the initial market reaction, it didn't continue its way down. It actually whipsawed after on the first and second candles, and then it made its final move after that. But it wasn't a nice clean reaction initially. So if I can go back to, so if we look at what the sentiment said as well for the Bank of England, so there wasn't anything that really surprised the markets, but the only highlight was the Bank of England said the June CPI surprised to the downside, but notes much less so for core goods and services. And off the back of that, traders saw a 68% chance of a 25 basis point interest rate increase at September meeting after the bank decision, and a 32% chance for no change. So again, there weren't any surprises. So the markets had been pricing in, speculating that the central bank would raise rates by 25 basis points. And off the back of that, you more or less got the opposite of that. So it was a bit of a buying the rumor and then selling the news off of the back of that rate decision. But if we're looking at some of the comments that we had seen here as well, again, as said, there wasn't anything significant or anything that was surprising that markets weren't expecting already. So what does that tell us about what to expect for the rate decision? Well, if we do get the same thing where the central bank, let's say they do raise rates by 25 basis points, that's going to be a bit more difficult to decide what the market reaction is going to be like if there is more of a leaning towards no change, but they do decide to raise rates. So first of all, if they raise rates as expected, but the statement that follows doesn't have any surprises, then you might not get that much of a big reaction from the pound, or you might get an initial amount of volatility, okay, but then that might be moderated if the statement itself doesn't have any surprises within it. So remember, whenever you're looking at interest rates, we have to keep an eye on the actual figure that comes out and then the rate statement that follows it, because sometimes you could get a surprise hike or surprise cut or no change, and then the central bank statement could have other bits in it that will then flip the sentiment into the other way. So let's say, for example, if the central bank does raise rates, let's say by 50 basis points, that's a surprise that no one is expecting. But if the statement says that if the statement shows that they're very dovish about the UK economy and inflation, then that then could moderate that market reaction, that initial amount of volatility from the market reaction, trying to take in the statement. So this one's going to be usually when you do get scenarios where you start to see traders and investment banks start to price in a different scenario, and in this case start to price in the odds of no change. That makes it more difficult to trade or to try and trade the economic release. So you're more or less relying on what the comments say than themselves to try and get an understanding of what the central bank is trying to do. So we've got about 15 minutes left. Just try and go through. So you can see there, you had the initial market reaction. This is about 20 minutes after the release. So yeah, you had the initial market reaction. Didn't last too long, only about 5 minutes or so of downside movement, and then it made its way back up. All right, so let's get out of this here. Actually, let me go a bit more forward. Yeah, okay, that's more or less it. All right, so what I want to show is the deviations then for the economic release that we had last time around. Get an understanding of what's had the biggest move, and we can see that in general, it has been GBPJPY that has had the strongest move within the markets that we've seen here. Also, don't forget, if you like the video and you're enjoying the content so far and you find it useful, don't forget to like the video, subscribe to the channel, get the word out there, and share that stream, because we're going to do a bit of a run through of the comments as well. But yeah, so as I said, the biggest market reaction that we had seen was from GBPJPY, and as I said, the previous sentiment, there wasn't any real surprises for the markets. The only highlight being that June CPI surprised to the downside, but no, it's much less so for core goods and services. Although this time round, we did have that UK core data ticking to 6.2% from the prior 6.9%. That does then help the case for a pause. So remember, the headline inflation figure, that's including food and energy. The core strips that out, and that's where you get a true measure of what inflation is like within an economy. And that's where central bankers would want to see, of course, they'd want to see the headline inflation go down, but they'd also want to make sure that the core is also going down as well, and they don't want that to heat up or to remain sticky. Let's say if the CPI data was sticky yesterday, all of it, and you didn't really see that much of a decline from the CPI data, then the idea for a hike would have been much stronger than it was yesterday, if that was the scenario. But of course, if core had seen a significant amount towards the downside, then it just means that the odds of a no change become bigger, not completely outstripping a 25 basis point hike, but they just become stronger. Okay, so this is so if we're having a look at this, you can see here where when we're looking at the deviations, this shows you how much the markets have reacted to how much markets have reacted to the economic release. Sam says is 0.25% the consensus. That is what the majority consensus is for a 25 basis point hike for the Bank of England. Okay. So as I was saying, here this is showing the initial market reaction for each of the different securities, so different assets that we have, and this first figure here shows the initial market reaction going to the wick of the candle. So I always like to capture the whole initial move. And then in the brackets shows you the move 10 minutes after the release going to the end of the candle. Now for this one, I'll be adding in for the next data that we do get for the Bank of England rate. Then I'll be adding in a 30-minute market reaction as well. So I did that yesterday for the FOMC. As you can see here at the bottom, over here, you can see that in the blue brackets, that represents the move 30 minutes after the economic release had occurred. And for sentiment and for interest rates, we also provide the sentiment as well as to what then caused the markets to move in that direction, or what would have helped the markets move in that direction. That's only for interest rates because, of course, you have text headlines that are part of it. And you have a bit more fat to chew on. Okay, but like I said, with the Bank of England rate decision, GBPJPY has seen the biggest market reaction out of the currencies. But yeah, so this is completely free, this deviation sheet, and the way you can get your hand on it is by subscribing to the MacroAce mailing list. So what will happen is I'll be sending. So what the MacroAce mailing list does is once you sign up, you'll get an email on a Monday, on next Monday, every Monday, giving you the link to the Google Sheet that I have here for the deviations for the economic release. Okay, and then also part of the email you get a short summary of what to expect for the week ahead. For Asia, the European session, and the US session. Not big paragraphs, quite short and concise, but because I go through more detail here in the live streams when talking about the economic releases. And then a summary of what happened over the weekend, if there was any bit of news to keep an eye on. But yeah, so that's the MacroAce mailing list. That's the link there for you. As I said, it's completely free. I send an email out every Monday for our users to look at. And as I said, you get free access to the Google Sheet deviations to see how big or how did the markets react to each economic release that we cover MacroAce. Some of the releases might not have a market, might not be up to date because they might not have had consistently large market reactions, or the market reactions that they had, which were initially quite large, had dwindled down to the point where you can't really get that much out of it. So we only kind of focus on the releases that are gonna have a big impact or high impact on the markets. Generally, those will be interest rates and jobs data like non-farm payrolls and inflation data at this moment, but sentiment will shift and change. So there might be other releases that then have more importance. At some point, CPI will lose its importance in the central bank's cycles or rate hikes and rate cuts, and then it will be back to maybe the housing data and other jobs data as well that the central banks would focus on instead, or the markets might be focused on instead. So that link I said is there for you for completely free or to sign up to. So what we're looking at is GBPJPY, EURGBP, GBPUSD, and let's get TICKSTRIKE up and running as well. So also on here on FinancialJuice. So FinancialJuice is a live voice and text service providing you up-to-date real-time news about what's going on in the markets and why the markets might be moving. If there is comments, let's say from central bankers like Fed's Powell yesterday, or if we do get extra comments that trickle through from central bankers, like we have ECB's Lagarde later today, who could shift the sentiment for future rate decisions as well. So you have your live voice here, which is there, okay. And on this side here, on this little news feed here, all your text headlines that we have, and on the left hand side you have your economic calendar, which also updates real time as well. Everything you need as a day trader, or if you're scalping the markets, is all in one place. So if you're looking to manage your risk and capitalize on potential opportunities in the markets that present itself, then having a live voice and text service is very key to that, because you can have one headline that will then flip the market's direction into a different direction. And you'll be thinking, okay, all right, you might capitalize on the trade without even knowing what the headline has, what the thing has caused it to do it, to move in that way. But if you understand what caused it to move and why it moved, what caused it to move, then you have a better grasp as to why the markets are reacting in that way. And it also might alter how then you would view the markets, depending on what the headline has, or depending on what the headline has said. But that's totally down to you, whatever is kind of suitable for yourself. But what you can do is you can sign up to FinancialJuice here in the link that I've posted, and you can on that link, that will get you signed up for the light version of FinancialJuice. The current view that I'm looking at is the pro version of FinancialJuice. So the light version isn't real time. There are adverts and there are delays. The pro version, it's real time, no adverts, no delays to the news feed at all. But if it's the first time you're getting used to what a news service is like, or to getting adjusted to a live voice and text service, then use the free version first. Get into it, understand how it kind of works and whether or not it fits into your trading strategy. If it doesn't, fine, no biggie. But if it does, and you start to get the hang of it, then what you can do is there'll be a button here which says near this bit that I've clicked here. There'll be a button here that says Go Pro at the top left hand side of the newsfeed. You can click on that, select your subscription, and then what you would do is you'll log out and log back in, and then you get the pro version of FinancialJuice. So make sure though, but if you do decide to go to the pro version straight away, make sure you have an account first on FinancialJuice, and that you've verified your account through your email in your emails that you would get, to then be able to, and then go back to the FinancialJuice page, then select your subscription, and then once you've selected your subscription, then and then log out and then log back in, and it should be good. Alrighty, okay, so we got about we've got about a minute and 45 seconds. Let me get my TICKSTRIKE up and running on here, and righty, let's get our UK setup. Okay. 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 1 minute to go. Okay. I'm going to go radio silent. I'll speak to you guys in a bit. Okay, hopefully you guys can all still hear me. I am back. Hopefully it didn't stop. All right. So yeah, as said, somebody said, "Are you muted?" Yeah, no, I was. I did say I'm gonna go radio silent. um, But yeah, no, I did go radio silent. So, all right. So the Bank of England keeps rates unchanged at 5.25%. Had seen that downside movement from cable, also from sterling overall. So that we're seeing that did see that weakness there. Let's do a quick measurement and a quick rundown of the headlines that had come through as well. Yes, you can trade without me. I gave you the I gave you the expectation. You should be fine. So all right. So let's go through some of the statements. I kid. All right. So let's go through some of what was said then. So the key things is, first of all, is that it was a 5-4 vote for no change. Okay, so 5 members voted for no change, right? Whereas 4 members voted for a hike. So that is what added to more of a stronger move towards the downside on cable, on sterling overall. And if let's say if it was more or less in line with, if you had more voters voting for no change, again, although it would have been bigger than what the markets were expecting, the idea of a pause is something that the markets were already starting to price in more so. Although, yeah, it doesn't. But as said, we kind of go through it here. So you had Bailey, the central bank governor, Broadbent, Dinger, Peel, and Ramsden voting to hold rates. Cunliffe, Green, Haskell, and Mann voted to raise rates by 25 basis points. Okay, so you still have those guys that are surprisingly Cunliffe, who used to be seen as a more dovish member of the central bank, being now on the hawkish side. So there's a flip in the sentiment then from the Bank of England in regards to where to hold rates, and it might just be for this meeting, and then things might go back to normal instead for the Bank of England. But there's confusion from the Bank of England. So if it was, one person then alter their view to flip to the other side, then we would have got a different picture altogether. But yeah, let's go through some of the other comments then. You also had, or if you were seeing the news feed, you had traders raising their bets on further Bank of England hikes and seeing the peak at 5.44% instead. So i.e. just seeing it not maybe looking at another rate hike. Okay, actually, here's a new little headline. There's a chance of, according to our IOIS curve, chance of Bank of England raising rates by 25 basis points in November falls to 64% from 81% before the rate decision. So there is still an expectation for a rate hike in November, but much less so than it was previously seen, from 81% to 64% instead. Okay, so more or less, that concludes the live stream. There are other couple of things that I want to go through as well. We have TICKSTRIKE here. So TICKSTRIKE, if you're unfamiliar with what TICKSTRIKE is, TICKSTRIKE allows you to listen into order flow and see how, another way to put it is, it shows you how strong the buying and selling momentum is of an asset that you're looking at, whether that's in FX, crypto. If you're looking at the futures market in any of those futures assets, if it's in ETFs and ETNs, your internals as well, like the VIX or the ADD, you can look at that, and also stocks as well. You can use TICKSTRIKE to see how strong the buying or selling momentum is. Now, what another feature of TICKSTRIKE is, so this gives you, TICKSTRIKE gives you a visual and audio alert for the strength in the momentum, whether it be buying or selling momentum. So here you can see that there is the number that represents the strength of the momentum. It goes from 1, which is the most sensitive to market reactions. So when you do see a little bit of buying momentum here, as you can kind of see now on a cable, then TICKSTRIKE will pop off. And when you drag this slider here, it goes from 1 to 15. 15 is the least sensitive to market reactions. So only when there's a big amount of buying or selling momentum that is occurring, only then will TICKSTRIKE give you an alert for it visually and audibly. And you can choose whether you want a visual or audio alert. Or you can kind of chop and change whatever works for you. So that's TICKSTRIKE there. So if you're scalping the markets, if you're trading, if you're day trading, particularly if this is made for day traders, then having TICKSTRIKE as a tool in your arsenal is quite key to be able to understand which way is the strength, which way is the momentum going. Is it in the buying side or is it in the selling side? Or how strong is that momentum? Should I say? I'll put it that way instead. So that's one aspect, or a couple of aspects of TICKSTRIKE. Then you have this lightning bolt. So this lightning bolt makes TICKSTRIKE super sensitive to market reactions. Okay, so each little buying or selling momentum, and you'll see the difference when I change it here. So 15. So the lightning bolt means you're 15 levels below 1. So remember, 1 is the most sensitive to market reactions. 15 levels below that makes it even more sensitive to the market reactions. So you see here. So imagine now the lightning bolt is on. It's on 15, which you can pretend is 1 from the non-lightning bolt version. Okay. Then if I put the lightning bolt on and then drag it down to 1, get ready to see the colors fly, but there you go. So you can see that, so the lightning bolt, as said, is uber sensitive to the market reactions. And you can see here when there's little bits of buying or selling going on, then TICKSTRIKE with the lightning bolt will go off. And the good thing about this is, same thing as with or without the lightning bolt, is you can adjust the level of the sensitivity that works for you. But the lightning bolt, as said, is made more for those guys or those people who are scalping the markets for opportunities. Okay, so you can see, yeah, it's too crazy for me. But that is the lightning bolt version of TICKSTRIKE there. So I'm going to turn that off because I'm getting a lot of sounds, more than I want, so I'm going to adjust it to where I usually have it. And of course, everyone has their personal preference for where they, how they want their TICKSTRIKE to work. But there is a 7-day free trial of TICKSTRIKE that you can have a little look at. No, I won't be covering the continuing jobless claims in my stream. No. Okay. So one thing I didn't do for you guys, I didn't do the initial measurement. So let's look at cable. Well, GBPJPY has always had generally the biggest market reaction. Oof, that's about 60 pips towards the downside there. And convert it so it's easy for you guys to understand. Okay, that's 16.5 pips there. Okay, let's have a look on GBPJPY. Okay, it's about 94.5 pips, let's say, from that there. Okay, so yeah, the initial market reaction was huge from that, and as said, the majority of that would have been from the split decision between the 5 members and the 4 members voting for no change and voting for a hike. So there's more confusion at the central bank, which then adds to the volatility if there isn't a clear, if nothing comes in as expected. Okay, so that is the release then. That is it for MacroAce this week. Don't forget to like the video, subscribe to the channel, get the word out there if you found the information useful. If you haven't, then do let me know in the comment section here if there's things that I might have missed or haven't said or haven't checked up on. Do let me know. Feedback is always important. But what you can also do is you can email me at tony@financialjuice.com for your feedback as well. If you're, of course, you guys are going to be busy trading. That is there for you to use as well to get in touch with me and give me your constructive feedback and criticism as well of what you found didn't work. All right, ladies and gents, thank you very much for joining me live from MacroAce. Enjoy the rest of your Thursday and the rest of your week, and I will speak to you guys next time. So remember that if you've subscribed to the MacroAce mailing list, you'll get an email on Monday morning with the deviations for any of the upcoming economic releases. And then you'll have access to the Google Sheets forever for free. Okay, that will be all yours. All right, see you guys next time. Bye.